Today we are analyzing StandardAero, a really critical maintenance, repair, and overhaul provider, or MRO, in the aerospace and defense sector. This comes, of course, after its October 2024 initial public offering.
And it's a fascinating case, isn't it? You have this company at a real intersection. On one hand, you've got immense operational growth potential, especially with the aerospace market recovering. But that's right up against a financial structure that's, well, let's say heavily influenced by its past private equity ownership.
Exactly. So the central question we're tackling today is this. Does StandardAero's strong operational position and, frankly, its high projected growth, does that really justify the premium valuation metrics we're seeing right now?
Or perhaps do the underlying issues, the financial leverage, the recent insider selling we've seen, and just the inherent industry risks, do those suggest investors should maybe pump the brakes a bit, be more cautious?
Right. And I'll be arguing that, yes, the fundamental shift happening in the MRO market, combined with StandardAero's strategic contract wins, really does validate the company's enterprise value and its forward outlook.
And I'll be coming at it from, a slightly different angle. While I agree the operational story sounds compelling, I believe the high price to earnings ratio and frankly the financial engineering tied to its private equity history presents some pretty material risks for public shareholders. I think it makes the current valuation feel quite tenuous, maybe vulnerable.
Okay. Well, let me lay out my position first. It's really rooted in StandardAero's accelerating momentum and its absolutely crucial role in the global aerospace supply chain. Look, the MRO sector isn't just, a service industry. It's actually a critical constraint on airline capacity right now. That means a strong player like StandardAero becomes essential infrastructure. We're seeing a powerful rebound in the aerospace aftermarket, and StandardAero seems perfectly positioned to capture that demand. If you look at recent performance, sales year-over-year TTM growth hit, 16.09%? And yeah, historical metrics are a bit distorted, but the EPS quarter-over-quarter growth, an astonishing 1150.62%, shows the rapid change that's underway. Now, what truly justifies the current price, in my view, is the future expectation. Yes, okay, the PE of 67.59 looks high if you're just looking at trailing earnings. But that historical number is, let's be honest, heavily skewed by one-time non-cash charges and complex accounting that came with the IPO and the refinancing under the previous owners. When we actually look forward, that valuation compresses substantially down to a forward PE of 22.49. And that huge shift reflects a very clear analyst consensus expecting sharp earnings growth. Specifically, 40.49% EPS growth projected for next year. This really validates the market's consensus target price of around $36.70, which shows confidence they can secure those key contracts for critical engine platforms, like the LEAP 1A, 1B, and the CFM66-7B.
A trailing PE of 67.59. Regardless of the IPO distortions, that signals a huge risk premium baked in already. And relying so heavily on the 22.49 forward PE for what is essentially a turnaround story, that feels risky in itself. While the revenue base is definitely strong, you cited $5.62 billion, the profitability underneath that is, it's genuinely thin. The profit margin stands at just 2.37%. For investors, this thin margin means there's very little buffer, almost no room for error against unexpected cost hikes or any execution stumbles. And furthermore, the balance sheet shows significant leverage. The debt-to-equity ratio is 1.01, and long-term debt-to-equity is equally high at 1.00. This heavy debt load is, let's face it, a direct legacy of the private equity history.
And while management, understandably, likes to tout adjusted EBITDA, we really had to exercise caution there. That debt restricts the company's financial flexibility, particularly in a higher interest rate environment. The MRO sector needs constant investment, often M&A flexibility, and that debt could be a real constraint.
That's an interesting point on leverage, sure, but let's connect the valuation back to the strategic necessity and market leadership here. The enterprise value to EBITDA ratio, it sits at 16.55. Now, for a market-leading MRO provider that's capturing vital, long-term market share in an industry that's capacity constrained, I think that's actually a reasonable premium. We're paying for highly secured future revenue streams, and StandardAero is actively de-risking that future revenue, through some very purposeful investments. We see this in two key areas. First, capacity expansion, like the Augusta facility, aimed at increasing high-margin business aviation MRO work. Second, and this is crucial, securing those strategic LEAP MRO agreements. The LEAP engine, as you know, is the successor to the CFM56, which was historically the most popular jet engine ever built. Securing the rights to service the LEAP platform, like they did with major carriers Solomare and Mauritania Airlines, is essentially locking in stable, high-margin, recurring revenue for the next, 20 to 30 years of the aviation cycle. These licenses, they're the ultimate competitive moat.
When you look at the fundamental efficiency metrics, how well they actually convert invested capital into profit, they seem to be struggling. Return on assets, ROA, is only 2.17%. Return on equity, ROE, is 7.25%. And return on invested capital, ROIC, is just 2.65%. To put those numbers in context, for every dollar of capital they deploy, they're only generating about 2.5 cents back. These are just not the metrics of a high-growth company efficiently leveraging its balance sheet to create shareholder value. Not yet, anyway. And you mentioned the aggressive forward PE. That projection relies entirely on overcoming some very real-world constraints. You're projecting 40% growth, which has to first contend with severe supply chain challenges. We're talking parts delays, higher material costs, slower turnaround times, and furthermore, the ramp-up of these crucial new programs like the LEAP engine MRO you highlighted, comes with acknowledged industrialization losses. Now, that's specialized jargon, sure, but simply means the initial higher cost for labor, time, and maybe waste associated with setting up entirely new repair lines and training staff before economies of scale kick in. So we're essentially paying a premium today for projected growth that must first absorb these unavoidable operational headwinds.
Okay, let's shift then. Let's talk about the financial structure and ownership.
Right, the risk of the prior owners. This company was brought public by the Carlyle Group and GIC Private Lid. And what followed the IPO? Massive secondary offerings. It felt like a clear signal of maybe reduced long-term confidence from those closest to the company. Insider transactions show a net negative flow, negative 18.26%. We saw enormous sales by both Carlyle and GIC in March and May of 2025. This private equity playbook, it often prioritizes providing exit liquidity for the former owners. My concern is whether capital deployment is now focused primarily on maximizing that exit strategy, maybe through debt paydown, rather than the aggressive reinvestment needed to actually unlock that 40% growth you're expecting.
I'd see it as a strategic necessity rather than a sign of, wavering confidence. The IPO and the subsequent offerings, yes, they are the standard playbook for a successful private equity exit. But ultimately, that results in strategic deleveraging for the remaining public entity. Yes, they pay down debt, but that actually positions the company better for future M&A and organic investments, now under a much cleaner financial structure. And more importantly, look at who's holding the stock now. Institutional ownership stands strong at 60.09%. That demonstrates confidence from sophisticated institutional investors who clearly see the long-term value creation story here. Furthermore, insider ownership, including the remaining Carlyle stake, is still substantial at 46.31%. That aligns management's interests, the proven playbook, as I sometimes call it, with long-term performance. And look, if these selling events were truly so detrimental, how do you explain the fact that major selling pressure didn't tank the stock? It held up, supported by strong institutional demand and the analyst consensus target around $36.70.
Well, I wouldn't argue the selling pressure tanked the stock, but it represents an opportunity cost. Those large selling events put a constant weight on the share price. Without that overhang, maybe more capital could have been deployed towards accelerating the business itself. It feels like a potential distraction from core capital deployment strategies.
Let's pivot back to operational stability, because I think that's StandardAero's true core strength and really justifies the EV premium. The company serves commercial, military, and business aviation markets. That gives it essential breadth and resilience. The military segment in particular offers robust long-term revenue visibility. Defense contracts are typically insulated from commercial ups and downs. They recently celebrated delivering the 1,000th J-85-5 engine to the U.S. Air Force, And, their selection by Sikorsky to potentially assemble the S-70 Black Hawk in England, that speaks volumes about their established defense credentials. This segment acts as a powerful revenue stabilizer against any commercial market fluctuations.
That military diversification is certainly important, I agree, but it's not completely without volatility risk either. We've seen how dependency on specific defense programs can introduce uncertainty. For example, the temporary grounding of the V-22 Osprey fleet, which uses an engine StandardAero services, that generates real immediate revenue impact and operational headaches. Now, while that grounding was temporary, the exposure to specific high-profile defense decisions is an inherent risk you just have to account for. And furthermore, operational execution risks across all segments remain a critical concern, and that's a point even analysts acknowledge. Remember, securing those valuable OEM licenses, the very core of your bullish thesis, is entirely dependent on maintaining the company's strong reputation. And that requires excellent execution, expert management of material costs, and achieving optimal turnaround times. Any failure, really, to manage the current supply chain pressures, say, delaying an engine delivery by just a week, could undermine the very reputation and operational excellence the company relies on to secure those crucial long-term contracts in the first place.
Okay, so to summarize my position, it remains bullish. StandardAero is executing what I see as a highly successful strategy in an MRO market that is structurally undersupplied and facing high global demand. They are translating strategic long-term contract wins like those generational LEAP agreements into superior forecasted earnings growth. Yes, the current PE looks elevated based on historical earnings, but the substantial drop in the forward PE, down to 22.49, and that consensus target price, they reflect what I believe is a very reasonable premium for an essential, well-positioned infrastructure provider in the global aerospace ecosystem. The growth story, I think, is just beginning post-IPO, and the capacity expansion is necessary to fulfill demand that is already largely secure.
And my perspective remains, cautious. StandardAero's premium valuation demands near-perfect operational and financial execution. And as we discussed, their current ROIC suggests they are still quite far from achieving that kind of efficient execution. Given the high debt load carried over from its private equity days, the significant insider selling activity we noted, and the very real margin pressures that come with scaling new programs and navigating supply chain instability. Well, the stock currently trades with significant risk in my view. Investors really need to be wary of relying solely on adjusted earnings metrics when the eventual consistent conversion to robust net income, which has to overcome those industrialization losses, remains a fundamental hurdle yet to be cleared.